We have so far concentrated on trend trading as the most lucrative of all trading tactics. In this part, we will cover some of the other trading tactics that are worth considering. Swing trading is a style of trading that uses price swings between pattern range bounds during trendless periods. As a swing is relatively short in duration, goals should be carefully designed in advance. A swing is often employed by smaller traders and mainly based on psychological rather than the usual fundamental forces. As a consequence, please use swing trading with caution, make realistic short-term goals, and never let a position develop unattended. Try to catch a price move after it bounces off a pattern support or resistance line. Day trading is another popular trading style. I personally advise using day trading with caution. It is not for novices as it requires skill and psychological preparation. Indeed, the majority of traders lose money while day trading. Trades are short in duration and require calmness of mind and swift reactions. Allowing your emotions to interfere with trading decisions is highly dangerous in day trading. You will often feel the urge to commit revenge trading after incurring a loss, so avoid it at all costs. If you feel emotionally upset, stop trading until you feel calm and lean again. The day trading style using involves micro trends and short daily swing moves. You may recognize them by using the same tactics and technical tools you would in longer-term trading, such as support, resistance, micro trend lines, micro patterns, a higher high and a lower low. But remember that those moves don't have big fundamental forces behind. This makes them unstable, hectic, short in duration, and not very reliable. You will have to be swift and lean. First, you need to come up with sound tactics in advance, including good risk management and determining stop loss and profit levels. Have a fast eye and a fast hand, and swiftly get in. If your goal is reached, then get out. Do not change your mind or break your rules while trading, as this will play too heavily on your emotions. If you feel upset or emotionally aroused, something is wrong. Either you are risking too high a percentage of your deposit, or you are committing too many trades at the short period of time. Determine the maximum number of day trades per session and do not exceed it. Overtrading is common sin among day traders. 3 to 5 trades per day are quite enough, with an earning goal of say 7 to 15 pips per trade. Make sure that you have no open positions during announcements. For day trading, you will need a good broker with a tight spread on majors. No bigger than 1.5 pips. There is a small number of such brokers. Although it doesn't matter with longer time frames. If you try to day trade on a pair with a bigger spread, your odds will be worse. Let's say both your stop and profit targets are set to 10 pips. If you have a spread of 3 pips, you will have to earn 13 pips in order to gain 10, while you could lose only 7 pips before the stop is hit. This makes a ratio of almost 2 to 1. That is a very unfavorable risk-reward ratio, because you will need to earn double what you are allowed to lose. In such a situation, try to find pairs and brokers offering tight spreads of say 1 to 1.5 pips maximum. Scalping is another trading style, but using it requires special skills and tools, which are out of the reach of many traders. For example, automated robot algorithms known as bots. I certainly do not recommend scalping. Indeed, you will do fine without it.